Hello, my name is Lindsay Shuck with Family Office Networks. Thank you for joining today's FON webinar series featuring Choice Housing Investments. Joining us today is Joshua Greenblatt. He has a 22-year career in multifamily real estate. Joshua has served in roles of all aspects of the industry, including acquisition and development, property management, and senior corporate leadership of an established national owner. In 2018, he co-founded Choice Housing Investments as a vehicle to raise and deploy equity into the acquisitions of existing operating properties, delivering immediate returns to investors. At the end of the presentation, we will have time for Q&A. We encourage you to send over your questions using your questions chat option at any point during this webinar so Josh can answer them accordingly.
Great, thank you very much, Lindsay. And I want to thank Family Office Network for coordinating this, and I want to thank all the attendees for joining today. As Lindsay said, my name is Josh Greenblatt. I have a 22-year career in the multifamily real estate industry. I played a significant role in the growth of a developer, owner, and manager, and touched all aspects of the real estate business. And in 2018, I co-founded Choice Housing Investments. Sorry about that. So today I'm here to talk to you about a few things. I wanted to give you some information about CHI's history, its track record, and its investment objectives. I want to talk about our current raise, which is a $1.5 million raise to be deployed immediately into a portfolio of 8 properties, and also wanted to talk to you about establishing relationships with investors interested in growing their portfolio of real estate investments, both in current and future acquisitions. So as I said, Choice Housing Investments was founded in 2018. The goal was to raise and deploy equity into multifamily real estate, and it was formed as the strategic capital partner of Vesta Corporation, which is an established developer, owner, and manager of multifamily, mostly focused in the affordable space. And I'll get to explain that a little bit later on. The acquisition goal, though, is to acquire existing affordable properties. We also will be looking at workforce properties and just general Class B and C housing with no affordability restrictions. The return profile is, for the current fund, is a projected fund IRR of 17 to 20%. Cash on cash return will be a 7% pref, and after that, an 80-20 split. And as the sponsor, we're participating in a minimum 10% equity for all of the acquisitions. Additionally, we're offering first loss protection to all investors. All outside investors will be paid before we get paid. And finally, we've added, because of the current crisis, we've added a voluntary redemption feature for any investors with concerns about staying more liquid. So as I said, Choice Housing Investments is the strategic capital partner for Vesta. Vesta was established in 1998. Predecessor to Vesta was formed in 1981. The current portfolio is 50 properties, 9,600 apartment units, located in 7 states plus Washington, D.C. So the company is based in Connecticut. It owns properties in Connecticut, Maryland, New Jersey, New York, Ohio, Texas, Virginia, and Washington, D.C. The current portfolio is valued at nearly $450 million, and return history has been greater than 17% for exited transactions, and the weighted cash on cash over the past 5 years is also in excess of 17%. The acquisitions that Vesta is looking at today and that Choice Housing Investments will be investing in are all affordable in nature, all properties that were either built with or rehabilitated with low-income housing tax credits. And a little bit of a history of how we got into this. First off, all the photos that you see here are going to be from properties that Vesta has either acquired or rehabilitated with low-income housing tax credits. And some of these properties CHI has invested in. In 2014, we started to see, historically, Vesta has been a developer, owner, manager, but we started to see properties that were newer vintage properties that didn't have an upfront rehab need. And so what we did was acquire a portfolio of properties with one investor based in Boston, Massachusetts. The properties were, two were in the Houston, Texas market, one was in San Antonio, and the balance were in the Rio Grande Valley, centered around McAllen. And what we did was the investor, we put together projections of returns. The investor receives returns based on the performance of the properties and the cash flow and disposition proceeds to which the general partner of those properties was entitled. When Vesta looked at its next round of growth, we wanted to explore what it would look like for Vesta to raise money on its own, and that's why Choice Housing Investments was formed. And what we've done is we acquired, and I'll get into these a little bit later, we acquired 6 properties in 2019, invested nearly $29 million in those properties. And we are adding now 2 properties to that portfolio, one that was acquired in May of 2019, but had some operational issues that Vesta wanted to overcome. And also one property that was acquired earlier this month. And both of those additions to the portfolio are in the suburbs of Albany, New York. To talk a little bit about affordable housing, though, I wanted to give you a sense of what affordable housing is. So affordable housing is properties that have some sort of income restrictions. They are properties, affordable. The definition of affordable is resident households, earn 60% or lower of area median income. Workforce housing has a little looser definition. It's an 80 to 120% of area median income. And Vesta's track record has made it a sought after partner in affordable housing. And we see the benefits of that in a few ways. First off, Vesta sees many off-market opportunities that are sourced through relationships. And then second, there are extremely high barriers to entry. And Vesta's track record has proven that it can perform in those difficult areas. There are significant compliance needs when you compare affordable to strict market rate housing. Additionally, federal, state agencies, local groups all have approval rights, and they want partners that have a proven track record in the affordable space, which Vesta has. When we talk about affordable, there's often a stigma, and people have a vision in their head of what affordable housing is, and I'd like to try to dispel some of that. The renter profile typically is entry-level teachers, nurses, police and firefighters, office workers, maybe distribution center and warehouse workers. There are a lot of people that really what they are seeking is, and what we're providing is a affordable housing option that is convenient to their place of employment. Oftentimes, there's a shortage of affordable housing in the United States, and what that means is oftentimes workers need to travel 45 minutes to an hour to get to their place of employment, and that's not the goal of the program. Is really to address that. historically, or normally, there's high demand for affordable housing. There are 100 renters for every 55 units. So two renters, actually two renters for every available apartment. During the crisis, that number has been exacerbated, and it's been reported that in some markets there are 20 renters for every available apartment unit. And so the demand for this is extremely high, and we believe that that will continue that the properties in which we're investing will continue to have strong performance based on that high demand. Let's transition to real estate investing in a crisis. Historically, real estate has offered stability during a crisis. It is a very stable asset class, and it offers a good balance to portfolios of investments that are more volatile. Layering onto that, of all the real estate sectors, in the current crisis, multifamily and industrial have been the best performers. There's been in the media, it's been documented how hospitality, how retail have really been hit by the crisis, and multifamily in particular. I can't speak to industrial, but multifamily in particular has been a very strong performer. And our view is that multifamily will continue to be a strong performer, and in particular, this portfolio will be even stronger given its roots in the affordable space. Renters typically are willing to spend on home expenses, and they'll defer others if need be. We've surveyed out all of our renters. Many of them have reported that they've held their employment through the crisis, and we've seen the benefits of that in how these properties have operated. So our properties during the crisis have maintained strong occupancy between 85 and 95%, and most of them are currently above 90. Collections have been at or better than 90% of pre-crisis levels, and many of our employees, many of our renters have, as I said, maintained their income, are essential workers and continue to hold their jobs, and we've seen the benefits of that. Choice Housing Investments Fund 1, let me talk a little bit about that. As I mentioned earlier, there are 8 properties, 2 in New York, 6 in Texas. All were constructed or rehabilitated with low-income housing tax credits. Commonalities are that Vesta is the general partner of the owning entity in all of these, and Vesta also provides on-site property management. Vesta brings its property management expertise to the properties, and Choice Housing Investments is the investment limited partner. Here I want to talk about the performance, the actual performance of the fund. The gross annualized cash on cash has been greater than 12.5% through the first quarter. The net annualized cash on cash return after certain fund expenses is 11.5%. The preferred return has been paid to all investors, and given that the property has performed better than the preferred return, we've been able to hold on to excess funds, which we had initially planned on distributing in July. We'll likely hold on to those and use those to stabilize the properties, stabilize the return to the investors through or as a result of the crisis. So what we're doing now is we've opened Choice Housing Investments to new investors. We're currently raising $1.5 million. New investors will come in. and we'll pay a true up in order to put them on an even footing with the initial investors, and they'll be invested across all 8 properties. And the goal is to maintain strong returns while providing diversity to the investors. And we believe that we can accomplish that. That's the presentation. I thank you very much. Apologize for the technical difficulties we had earlier, and would love to answer any questions you may have.
Thank you so much, Joshua. Again, this is Lindsay with Family Office Networks. I would like to encourage all of you to chat over your questions so we can have an open dialogue with Josh while we have him live. And we will go into Q&A now. So Josh, why are you raising a fund versus investing in single assets? If you can kind of elaborate on that a little bit.
Sure, thank you very much. What we have, many investors, many developers raise money for single properties. We have looked at this, that Vesta has had a proven track record for more than 20 years and has been profitable through that whole period. And from time to time, certain properties have performed better than others. But the portfolio as a whole has performed well and been profitable. And we looked at this in a very similar way. We wanted to bring almost mutual fund type returns to our investors by doing this. And we felt that in investing across multiple properties in a fund, we'd be better able to do that.
Okay, perfect. Has there been an impact during the COVID on any operations or returns for existing portfolios that you currently have?
I think there's definitely been an impact in how we've operated the properties. We're complying with all federal, state, and local regulations in terms of social distancing, PPE, other kinds of regulations that have been put out there. But we've been able to adapt. We now work on virtual leasing. Our offices, while they're closed to the public, are fully staffed and have been fully staffed throughout the crisis. And we think that being able to do this has really allowed us to maintain the performance of those properties.
Okay, great, thank you. Again, anyone else that has any questions, please send them over now. Josh, is there anything else that you wanted to elaborate on while we wait for some questions to populate through?
I would really like to say that this is a good, stable investment, especially during these turbulent times. We've received, I guess let me talk a little bit about the structure of the $29 million that we have invested to date. We have a strong relationship with an institutional partner that's providing 85% of the equity for the first 6 deals in the portfolio. As I said before, we are, as sponsor, putting up our money. We've invested more than 10% of the equity needed. And then we have a group of individuals that we've raised money from that have invested. Many of those have added to their investment once we opened up Fund 1 to new investors. We've also brought in, they've referred us to new investors, and I think that's an indication of the satisfaction they've had in participating with us, that our investors are interested in growing their positions, but also in referring us to their friends, to their associates, their colleagues.
Okay, perfect. And we did have a question come over, and it's a little bit more related to COVID, which I know we just touched on. Has there been a forbearance for rental day requests due to COVID-19? What is the percentage of those that they have requested?
So there's been no forbearance. We are current on all of our debt. and most of these all of these properties, excuse me, have first mortgages with either state agencies, with Fannie or with Freddie agency loans, and we have not needed to, and we don't anticipate needing to request forbearance. We've been able to maintain strong occupancy. We're looking at improving the occupancy at many of the properties, and we've also, as I said earlier, had collections that are 90% or better of pre-COVID levels.
Okay, great. Thank you. Again, we're going to take a last call for any questions for Josh while we have him live on today's webinar. He'd be happy to answer any questions that you guys had regarding choice housing investments. And we again encourage your questions. A 1.5 million raise seems somewhat small. Can you give us a quick breakdown on the properties you are acquiring? How many units per price unit? Are these all value add? Great question, Brad.
Thank you. These are value add, more value add in terms of the we're bringing in a more professional property management company than had been in place at the properties previously. The two deals that we're adding to the fund have that equity need of $1.5 million. They're two properties located in the Albany, New York market, and they're 200-unit properties plus or minus. One is a family property that was constructed in the 70s and was rehabilitated in 2014. So from a physical standpoint, it's in great condition. The other is an elderly property, senior property that was built in two phases in 2003 and 2004, also in good physical condition. And that's the property that was acquired in June of this year. The family property was acquired in May of last year, had some operational challenges that we wanted to overcome before we brought in outside investors.
Okay, well, as of now, there's no other questions that have come through. Like I was saying before, we will be following up with all of you individually in case anything comes to mind. I know Josh would be happy to speak with you. My name is Lindsay with Family Office Networks, and I look forward to connecting with you all shortly. I hope you guys have a great day, and thank you very much for joining us.
Thanks, everyone.